But it's very common for us to think that lowering the interest rates, whether it be done by the Fed or lowering, forcibly lowering credit card interest rates to be capped at 10% when it's averaged to be above 20-25%. Essentially, what I'm trying to say here, or trying to ask here, is how does this benefit us, right? So we know if the Fed ever lowers interest rates, that effectively means that borrowing money is cheaper. So when we borrow money as consumers, we tend to buy more vehicles, we tend to buy houses, because it's essentially a lot cheaper to buy things or to rent money, which is through loans, and we use those loans to buy things. And this heats up the economy. And this basically is the idea of why certain politicians or why certain people want the interest rates to decrease, because it's cheaper to borrow money. When it's cheaper to borrow money, we can buy more. When we buy more, that heats up the economy, and if we buy more through debt, then Americans will be more in debt. And in the long run, that is a lot more detrimental to the American person, or to the American people, because debt is bad. Because we would rather, well, personally, I would rather, if I don't have the money to buy something, then I won't buy it. If I don't have the money to buy something, then I won't buy it. There's no need for me to take out a loan, because taking out a loan just hides the fact that I'm just broke. You know, there are exceptions to this matter, for even for myself, because there's practically no way nowadays to save enough money to buy a house. In theory, you can, but it's gonna take forever, and we don't have that much time here on Earth. So, when it comes to vehicles, if I don't want to spend the extra 10, 20, 30K, then I just won't buy the vehicle. I'm okay with what I have. But this conversation is about myself. This conversation is about how does lowering the interest rates affect the American people. So now, I just talked about interest rates for the average consumer. If we take out loans to buy vehicles, if we take out loans to buy more consumer products, if we take out loans to buy more houses, then that means the economy heats up, because things are moving, assets are being transferred, and that's houses. Stocks go up because it's a lot more cheaper to borrow money to invest, and so people like to take that risk. So the economy heats up, and when the economy heats up, then inflation heats up with it. If the inflation heats up, then the value of the dollar decreases, because there are a lot more dollars in circulation in the market. The only way to mitigate that is to increase interest rates, and here's that never-ending oscillation between lowering interest rates and heating up the economy, as opposed to increasing interest rates, and that prevents the economy. It cools it down. And so, how do corporations benefit from this? Well, practically the same idea. If corporations want to focus on expanding, want to focus on R&D, want to focus on hiring, which is expanding, then they are able to borrow that money at a cheaper rate to focus on those priorities. And because of the recent the beautiful bill, corporations are incentivized through less taxes to expand and to borrow money. I'm not going to go into details of what exactly it says, but they are tax incentivized to pretty much borrow money to focus on expanding the corporation, focusing on R&D, focusing on pretty much hiring people. And what does that do to the economy? When we hire people, that also heats up the economy, which is a good thing for when it comes to the American person, because they get hired, they can have a salary, they can do something. The only issue is, or the main issue that I want to say here is the main one for the long run is debt. If we owe, then it's harder for us to save, it's harder for us to invest. Things that get a lot more pricier because of inflation, and that leads to this leads to inflation. If there's more money in circulation, if there's more money to be had, then there's more money to be spent, and that heats up the economy, and that leads to the devaluation of the dollar. So what now? If credit card interest rates are capped at 10%, if interest rates are lowered at a certain rate where it incentivizes people and corporations to borrow money at a cheaper rate, to go ahead and do something with that money, then what now? Then we are in a typical stage that happened in after the pandemic. Essentially, money was given practically to the American people through the stimulus checks or stimmies to pretty much incentivize them to spend money and stop hoarding money. And of course, at the time, it was a lot cheaper to borrow money to purchase homes. And what does that happen to the value of homes? The value of houses increase in the value of the homes increased because it was a lot cheaper to borrow money at the time of 2021. So when that happens, a lot of people get hit with FOMO. And what FOMO essentially does is that because they are able to buy or are able to borrow such money, then they want to buy a house. If a lot of people are bidding for the same house, and that just artificially increases the money. The money to buy that house because the demand is high and there's a short supply of houses. It's a physical short supply of houses in this situation, where if there's a lot of demand for a single house, then that's gonna boost up the price of the house. The price of the house boosts up, then the surrounding properties in that area are also going to increase. And then if the house prices increase, then that's essentially leads to people being forced to borrow more money, and the average consumer is basically locked out, because if the person doesn't want to borrow that much money or can't borrow that much money, then only a select few people can buy this house. So what now? Unfortunately, there's no solution to this other than just lowering or increasing the rates, I should say. If we increase the rates, then it's a lot more expensive borrow money, so corporations tend to do layoffs. They tend to borrow less money, go figure, and consumers are stuck with this debt, the debt that they had when they took out a loan for a vehicle, consumer debt as well. And luckily, overall, it's bad to borrow money. Just in my opinion, if we're gonna borrow money for a car, then I hope it's not over 10k or even 15k. But to my point, if you're locked in at a fixed interest rate, then at least you have that. If it's variable, like some mortgage loans have, if it's variable, then you're kind of screwed. If it's fixed, at least you have that. Make sure you know what you're signing. Always get a fixed interest rate. At least that way, if you're gonna borrow a large amount of money to buy a certain vehicle, I wouldn't recommend it. If you are going to do it either way, then at least you'll be stuck in it to sub 3% loan. But anyways, that's pretty much the idea of the video. To talk about lowering interest rates, the long-term effects it has on the American consumer, short-term effects that we can experience and enjoy, and how to reverse a heating economy that was done by lowering interest rates, and increasing interest rates will definitely cool down the economy. Nothing, fellas. This video was inspired by a certain video that I watched earlier right now. It basically talked about lowering interest rates and how pretty much what I just talked about. I hope to be inspired soon by another finance topic that I see on social media. Alright, fellas.
Can things get any worse? Nope, wait, whoa, I withdraw the question. Aunt May, sorry I'm late.
Peter, don't be sorry. I was just worried about you. Thank you for taking the time to help me.
It's no problem, Aunt May. Let's go in.
Now about your loan, Mrs. Parker.
Oh no! I've got to get away!
Run!
Ladies and gentlemen, I am making a withdrawal. Kindly remain calm and silent so that we can avoid unnecessary bloodshed.
going?
Your boy is quite the hero.
Stop right there, Dr. Octavius.
Here's a small sample of what's in store for you, Spider-Man. What an unpleasant surprise. Still, not one for which I am wholly unprepared.
All right. Get it.
You got it, Doc.
He won't listen to reason. He still has those tentacles.
Even you can't stop me, Spider.
Why would they insurance on your benefits? Try not to run into my fist with your face.
This is for Rose